What's up guys, Douglas here with Investing Unlocked. In this video, I will do an in-depth analysis of the best undervalued massive growth stock to buy right now, and I will explain my investment thesis as to why I believe this stock can easily double and even triple your money in the next few years, providing a life-changing building wealth opportunity. Growth stocks were absolutely hammered in the first half of 2022, but history has taught us that every bear market is always followed by a bull market. So the time could be ideal for investing if you can find growth stocks with solid fundamentals that are also selling at a huge discount. And of course, knowing which growth stock to buy and when is the key. So let's get unlocking. What's going on guys? In my last video, I shared with you my step-by-step process of how to find stocks with tremendous growth expectations that were also selling at an amazing discount. And we found 4 potential big winners that have the potential to deliver oversized returns. We identified Broadcom, which operates in the semiconductor industry and is based here in the USA. Alphabet, which is Google's parent company and operates in the internet content and information industry. Also, Microsoft, which of course is another high quality growth stocks, and dispenses introduction and operates in the software industry. And the last one was Taiwan Semiconductor Manufacturing Company, which is based in Taiwan, as the name suggests. Now remember, this is not financial advice. I'm simply sharing my investment thesis. You should always do your own due diligence. From these 4 candidates, I did a little further research and decided to go with one company, Alphabet, Google's parent company. Now, I will share with you my investment thesis and why Alphabet has the greatest potential to deliver tremendous returns compared to the other options. And you'll regret not buying during the great Nasdaq crash of 2022. First of all, let me quickly recap. How did I get to select these 4 candidates? In my last video, which I'm leaving a link in the description below, I share with you my process to find companies that have tremendous growth potential and were selling at a discount compared to their peers. They were all very profitable, with no liquidity problems, and we're all trading at least 20% below their all-time highs. So why Alphabet? Ticker symbol GOOG or GOOGL. Hey guys, before we get started, and before I forget, please go ahead and smash the like button and subscribe to our channel so that you can get weekly ideas and investment strategy right here. All right, so why do I consider Alphabet the best buy opportunity right now? Let me start by giving you a little background first. To find great growth stocks, we need to identify powerful long-term market trends and the corporations that are best positioned to profit from these trends, and look for the companies that have strong competitive advantages. Alphabet is the parent company of search engine Google, streaming platform YouTube, and the Android mobile operating system, as well as the autonomous car company Webull. Google is always at the forefront of technology, and the obvious reason to invest in Alphabet is Google, the company's utterly dominating internet search engine. Google has accounted for 91% of the worldwide internet search share for the last 24 months. The second and closest competitor is Bing search engine with 3.29%. The company is so dominant in its business, it became a verb. Once upon a time, we used to look up stuff on the web. Now, we Google it, right? That gives Alphabet exceptional pricing power over its competitors. And that's just the beginning. YouTube is the largest streaming video website in the world and is the second most visited website in the world as well, behind only one website. And which website would that be? You guessed it right, the Google search engine website, which takes the #1 spot. So one company holds the #1 and 2 spots worldwide, and that company, my friends, is Alphabet. YouTube alone is used by over 2 billion internet users every single month. And the best thing about YouTube is its business model. While Netflix, Disney, and Warner Bros., HBO, spends hundreds of billions of dollars creating content to attract users to their platforms, YouTube basically gets it for free for its creators. You are welcome. No, but seriously, the creators put on the time and effort to create the content, and if they reach a certain milestone, which is 1,000 subscribers and 4,000 hours of valid public watch hours in the last 12 months, then they are able to join their YouTube partner program and are rewarded with a small percentage of the advertising revenue. I mean, it's an amazing business model. Creators can work for months before they can even get a little piece of the profit. So you can see how this has a significant impact on advertisement revenue and profitability for the company. But there are more things to be more excited about when we see what Alphabet's doing with its free cash flow, which, by the way, in 2021 reached a whopping $67 billion in free cash flow. Just to put that in perspective, Google free cash flow is bigger than the entire GDP of 118 countries out there. Google Cloud holds the #3 in the world, or 9% of the total global cloud market share, behind Amazon Web Services and Microsoft Azure. And cloud infrastructure spending is still in its infancy, so Google Cloud has the potential to become a significant source of operating cash flow for the company in the next decade. Since the global market cloud is expected to have an annual growth rate of 19%. Alphabet is also investing in areas like autonomous driving, cutting-edge medical technology, artificial intelligence, and quantum computing. Lots of exciting stuff for the future. With Google stock down more than 26% from last November, shares are now selling near 21 times forward earnings. What that actually means is that in real terms, ladies and gentlemen, is that right now it is one of the cheapest times ever to acquire Google in the history of the company trading as a public company. Especially when we know that Alphabet has generated an average annual return of almost 18% over the last previous 15 years and outperformed the market by over 10% on an annualized base. So at the beginning of the video, I told you that I thought this stock could easily double and even triple in a few years. Here is the math behind this argument. The PE ratio is calculated by dividing the market value, price per share, by the company's earnings per share. So Alphabet is selling for around $110 at the time of writing. When dividing this by the company's EPS of 5.28, we get the company's current PE ratio of 20.83. Now, Alphabet's average PE ratio in the last 5 years has been 32.78. So, my investment thesis is that as the market stabilizes a little, we will see the PE ratio slowly getting back to the historical average, and then some more. If we use the same formula above and use the average PE ratio that Alphabet traded over the last 5 years, which is 32.78, we can find that Alphabet should be trading at $173. Not double yet, but remember that is considering EPS staying the same. If we add the 15% growth on the EPS side, then we are getting close to $200. And on the higher end of the spectrum, not too long ago, Alphabet had a PE ratio of 65. This would equal to a stock price of $343, which is not something crazy. Just to put that in perspective, right now, as I'm writing this, Pinterest, a popular social media site with 478 million monthly active users, has had revenues of 2.7 billion and a profit margin of 8.1%. Well, Pinterest has a P ratio of 76.9. Twitter, another popular social media company, has about 330 million monthly active users. Half of it are fake accounts according to Elon Musk. Twitter has a P ratio of 161. Am I out of my mind here? Why in the universe investors are willing to pay $161 for $1 of earnings of Twitter, $76 for $1 of earnings of Pinterest, and only $21 for $1 of earnings of Alphabet? YouTube alone is more valuable than both businesses put together. YouTube's 2 billion monthly active users make the company a cash machine, and they still have a lot of room to grow. But somehow, investors are willing to pay 4 times more for Pinterest and 8 times more for Twitter. It doesn't make any sense to me. The market can be irrational for some time, but it doesn't stay irrational forever. The last thing I want to do is to check on Google's intrinsic value. So I headed to the website gurufocus.com and checked for Alphabet's intrinsic value using the discount cash flow model. And I find out that Alphabet's intrinsic value currently stands at $1,372. This confirms our thesis that Alphabet is grossly undervalued and a once-in-a-lifetime opportunity, as the intrinsic value is more than 12 times what the company is currently trading for, which gives investors a substantial margin of safety. Well, folks, remember at the beginning that I told you that I wanted to find the best deal for your money right now. I feel that I really accomplished the mission here. Remember this, I'm just sharing information. This is not financial advice. You should always do your own due diligence. Besides, it is important to understand that investors should expect a lot of short-term volatility in the coming months. But I believe Google should be a solid name if you are investing for the long term. Make sure to smash the like button and subscribe to our channel if you want to receive ideas such as that. Thank you for watching, and I will see you in a few days with more ideas. Keep investing.